Every financial apocalypse begins with numbers that seem manageable to bureaucrats and terrifying to anyone who understands what those numbers actually represent. Today, those numbers have crossed from terrifying into territory that suggests the entire global credit system is approaching complete breakdown. U.S. credit spreads haven't just blown out to 12 basis points as we previously reported. They've exploded past 20 basis points and are accelerating upward at a pace that indicates systemic panic rather than normal market stress. London credit spreads have gone completely parabolic, hitting 25 basis points in what can only be described as institutional terror spreading through the heart of global finance. These aren't just numbers on trading screens. These are mathematical signals that the credit creation mechanism underlying modern civilization is shutting down in real time. And when credit creation stops, everything else stops with it. Economic growth, business operations, employment, consumption, and ultimately the political stability that depends on economic functionality. We're not watching another financial crisis develop. We're watching the financial crisis, the one that ends the debt-based monetary system that has defined global economics for over 50 years. And the scariest part isn't how fast it's moving. The scariest part is how completely unprepared the institutions responsible for managing financial stability have proven to be. The numbers that broke everything. To understand why current credit spread levels represent existential threat rather than temporary market stress, we need to examine what these spreads actually measure and why the current trajectory indicates systemic breakdown rather than cyclical adjustment. Credit spreads measure the additional yield that borrowers must pay above risk-free government bonds to compensate lenders for default risk and liquidity constraints. Normal credit spreads for investment-grade corporate borrowers typically range between $100 to 300 basis points over government bonds. During periods of market stress, spreads might widen to 400 to 600 basis points. During financial crisis conditions, spreads can explode beyond 1,000 basis points as credit markets freeze. Current U.S. credit spreads at 2,000 plus basis points represent conditions that exceed 2008 crisis levels. London spreads at 2,500 basis points indicate a complete breakdown of normal credit market functionality. These levels don't just signal stress, they signal that the mathematical relationships supporting credit creation have become dysfunctional. But raw spread levels tell only part of the story. The acceleration rate reveals something far more dangerous: the loss of institutional control over credit pricing mechanisms. When spreads move from 12 to 20 basis points within days, it indicates that normal market making and liquidity provision systems are failing. When they continue accelerating toward 25 plus basis points, it means the failure is cascading through interconnected systems faster than interventions can be implemented. The private credit detonation. The most dangerous aspect of the current credit crisis involves the simultaneous detonation of private credit markets that have grown to over $3 trillion globally while operating with minimal regulatory oversight and maximum systemic interconnectedness. Private credit enters 2026 facing its most challenging environment since the 2008 financial crisis. Cracks are emerging in corporate credit, a series of high-profile leveraged loan defaults in late 2025, and the rising use of payment-in-kind toggles and direct lending point to mounting stress. But the crisis goes far deeper than defaults and payment deferrals. The entire private credit model depends on refinancing capabilities that have evaporated as credit spreads exploded beyond sustainable levels. Private credit borrowers, who expected to refinance at 8 to 10% interest rates, now face refinancing costs of 15-20%, levels that make most business models mathematically impossible. Jeffrey Gundlach of Double Line Capital warns that private credit could spark the next financial crisis, calling some investment vehicles the ultimate sin. Jamie Dimon of JP Morgan uses the cockroach analogy. Where there's one problem, more are likely hiding. This analogy is fitting. Private credit problems are not isolated. They are deeply interconnected with traditional banking through credit lines and shared borrowers, creating pathways for financial contagion. With $3 trillion in exposure, the sector's complexity and opacity are a major concern. Problems could cascade through the financial system before anyone grasps the full picture. The risk extends beyond private credit to the broader shadow banking system. Non-bank financial institutions now account for nearly 10% of bank loans, creating a direct transmission line for stress. These entities, money market funds, hedge funds, and asset managers all depend on stable credit markets. When credit spreads explode, they face simultaneous funding and liquidity crises that feed on each other. Here's the mathematical dilemma. Shadow banking entities manage more assets than the traditional banking system, but operate with less capital and fewer safeguards. When this sector faces stress, the amplification effects can overwhelm traditional regulatory tools. While shadow banking implodes, traditional banks face their own crisis. Consumer credit risk is rising, with auto and credit card delinquencies accelerating. Commercial lending is in even more trouble as businesses struggle to refinance debt at sustainable rates, with costs jumping from 6% to as high as 15%. Banks are tightening lending standards, not due to a lack of capital, but because the economics no longer work. They cannot price loans profitably while managing the growing risk of default. When banks stop lending because the fundamental market has broken down, it signals a crisis that policy adjustments alone cannot fix. There's a storm brewing in the financial world, and it looks like the Federal Reserve, the institution we rely on to steer the ship, might be losing its grip on the wheel. What we're seeing right now in the credit markets is genuinely alarming, and it points to a problem far deeper than what we've faced in the past. Traditionally, when a credit crisis hits, the Fed has a playbook. They can cut interest rates, launch quantitative easing, or directly inject liquidity into the market. These actions usually restore confidence and bring credit spreads. That's the extra interest companies pay to borrow compared to the government, back to normal. But this time is different. Despite the Fed's efforts, credit spreads are widening at an accelerating pace. It's like they're pushing on a string. Ooh, the old tools just aren't working, suggesting the problem is bigger and more complex than the Fed can handle. Adding another layer of uncertainty is the potential nomination of Kevin Warsh as the next Fed chair. Warsh is known as an inflation hawk, someone who prioritizes fighting inflation above all else. Normally, a credit crisis demands easy money policies to keep the system afloat. But if Warsh is in charge, the market is completely paralyzed, wondering what he would choose if faced with a conflict between fighting inflation and managing a financial meltdown. Will he tighten policy to curb inflation, potentially crashing the credit markets? Or will he pivot to save the system, abandoning his hawkish principles? This uncertainty itself is destabilizing. The signs are flashing red. A severe financial crisis seems not just possible, but highly likely to hit this year, and our ability to navigate it would fall on the shoulders of two key figures: the next Fed chair, potentially Warsh, and the Treasury Secretary, Scott Bessent. Looking at their track records, the outlook for effective crisis management isn't exactly encouraging. Yes, Warsh was at the Fed during the 2008 crisis, but the financial landscape has mutated since then. Today, as problems are tangled up in the opaque world of shadow banking and the explosive growth of private credit. These are sectors that are far less regulated and understood than the traditional banking system we dealt with in 2008. The scale of the problem is just immense. The current stress isn't isolated. It's hitting traditional banks, shadow banks, and private credit markets all at the same time. The sheer size and interconnectedness of these sectors might be beyond anything the Fed has ever successfully managed. The current level of credit spreads is a screaming signal that the Fed's usual toolkit is simply outmatched. While all eyes are on the financial sector drama, the real, immediate pain is about to hit Main Street through what I call the corporate refinancing catastrophe. Over the next 2 years, a staggering $4.5 trillion of corporate debt is coming due and needs to be refinanced. This isn't unusual. It's the normal cycle of business. Companies roll over their old debt, usually at similar or even better rates. It's been the lifeblood of corporate America for decades. But here's the catastrophe. With today's sky-high credit spreads, that routine refinancing is now impossible at a sustainable cost. Imagine a healthy company that previously had a 5% loan. They expected to refinance it at maybe 6%. Now, they're staring down the barrel of a 12% or even 15% interest rate. Most businesses simply don't generate enough cash flow to survive that kind of shock. This isn't about bad management or failing products. We're talking about fundamentally sound companies facing potential insolvency simply because the credit markets are broken. The cost of money has become too high to bear. This is what makes the coming crisis so different from a normal recession. Usually, a downturn hits cyclical industries like manufacturing or construction the hardest, but this refinancing crisis is indiscriminate. It threatens companies across every single sector all at once. When credit becomes this expensive, even the strongest, most conservatively run businesses are at risk. It's an existential threat that doesn't care how well you run your company. We're already seeing signs of extreme distress. Look at the rise of payment in kind or PIK interest in the private credit market. PIK is a desperation move. It's when a borrower can't afford to pay their interest in cash, so the lender just adds that unpaid interest back onto the principal of the loan. The debt just gets bigger and bigger. Right now, publicly traded business development companies are receiving about 8% of their income through these PIK arrangements. This tells you that companies are already unable to service their debt at current rates. They are kicking the can down the road, delaying an insolvency that seems increasingly inevitable. And this crisis isn't just a domestic issue. The credit spread explosion that started in the US and London is now spreading like a virus through the international financial system. Instead of global markets providing a buffer or a source of stability, they are amplifying the stress. Capital is fleeing to safety, and credit is tightening everywhere. What begins as a problem in one corner of the globe quickly becomes everyone's problem, creating a vicious feedback loop that makes the situation even worse. We are standing on the edge of a precipice. The Federal Reserve seems powerless, the leadership is untested against this new kind of threat, and a massive wave of corporate refinancing is about to crash against a wall of impossibly high interest rates. This isn't just a prediction. The early tremors are already being felt. The question is no longer if a crisis will happen, but how severe it will be when it fully unfolds. Thanks for watching, and be sure to subscribe for more updates as the situation develops. Stay safe out there. European credit spreads are following US and London patterns, with spreads widening to 15-plus basis points and accelerating. Asian credit markets show similar stress patterns. Interconnected derivative relationships and funding dependencies create synchronized responses. International transmission occurs through multiple channels, currency swap arrangements, and derivative counterparty relationships. Also, international lending facilities and shared exposure to multinational corporations facing refinancing problems. When credit spreads explode simultaneously across major financial centers, it indicates systemic vulnerabilities. Global financial integration means problems starting in one center cascade globally before national authorities can respond. No major economy can maintain normal credit market functionality, while other major economies face credit crisis conditions. Economic interdependence, efficient in normal times, becomes a transmission mechanism for systemic breakdown during crises. The liquidity evaporation. One dangerous development is the evaporation of credit market liquidity. This makes normal price discovery impossible, forcing trading into patterns that amplify volatility. Market makers and institutional liquidity providers have withdrawn as spread volatility exceeded risk parameters. Without professional liquidity, credit markets operate through forced transactions, not normal supply-demand equilibration. Forced transactions happen when institutions must buy or sell regardless of price due to requirements or margin calls. When forced transactions dominate, markets can gap violently without normal resistance levels of liquid markets. Liquidity evaporation explains violent jumps in credit spreads, not gradual adjustments. Without market making, small order imbalances create large price movements, amplifying the original movement. Liquidity evaporation means credit markets cannot provide pricing signals for risk assessment and capital allocation. When markets cannot price risk accurately, the entire credit creation process becomes dysfunctional. The derivative amplification. The most dangerous amplification mechanism involves derivative relationships. These were designed to distribute risk, but are instead concentrating and amplifying credit stress across institutions. Credit default swaps, interest rate derivatives, and currency hedging create mathematical relationships between institutions. These force coordinated responses to credit stress rather than allowing independent adjustment strategies. When credit spreads move violently, derivative positions require immediate collateral adjustments through variation margin payments. This can force institutions to sell assets or reduce lending precisely when market stability requires additional liquidity. Derivative relationships also create uncertainty about actual loss distribution because complex contracts can shift losses. This uncertainty prevents institutions from accurately assessing their own risk exposure or that of their counterparties. The derivative amplification effect means that credit problems spread faster and more extensively than underlying economic problems. Mathematical relationships designed to manage risk become transmission mechanisms that amplify risk when stress exceeds normal parameters. Government and regulatory responses to the current credit crisis have proven completely inadequate. These problems exceed the scope and complexity of traditional policy tools. Treasury and Federal Reserve officials describe current conditions as manageable market stress. Yet, credit spreads accelerate beyond crisis levels, showing a stark disconnect. This suggests policymakers either misunderstand the severity or minimize public awareness of systemic breakdown. Traditional policy focuses on providing liquidity to specific sectors or institutions. Current problems involve systemic breakdown, requiring coordinated intervention. The Fed's tools were designed for 2008-like crises. But current conditions involve shadow banking, private credit, and derivative amplifications. These operate at scales and speeds exceeding Fed operational capacity. International policy coordination faces even greater challenges. Problems transmit globally faster than institutions can organize responses. By then, conditions may have deteriorated beyond effective intervention. Understanding credit market breakdown reveals why current conditions are an existential threat. Week 1 to 2, credit spread explosions force corporate refinancing delays. This creates immediate liquidity stress for companies with near-term debt maturities. Week 3 to 4, companies announce operational adjustments, including hiring freezes. They delay capital expenditure and reduce inventory to preserve cash flow. Month 2 to 3, corporate refinancing failures force bankruptcy filings. Asset liquidations depress prices, stressing financial institutions. Month 3 to 6, Employment effects begin as companies reduce operations. This matches reduced financing, creating consumer spending reductions. Month 6 to 12. Economic contraction becomes self-reinforcing. Reduced activity, employment, and spending create additional loan defaults. This worsens credit market conditions and forces further tightening. This timeline assumes policy interventions prove inadequate to restore normal credit market functionality. Current credit spread levels suggest normal policy tools may indeed prove inadequate. The most frightening aspect involves mathematical relationships. They suggest the crisis has progressed beyond normal market mechanisms. $4.5 trillion in corporate debt needs refinancing over 24 months. This cannot be accommodated at current credit spread levels without massive corporate failures. Private credit markets with $3 trillion in exposure cannot absorb current stress levels. This would lead to extensive defaults, cascading into traditional banking. Shadow banking entities manage more assets than traditional banks. They cannot maintain operations when credit markets become dysfunctional. This creates liquidity pressures, reinforcing credit market stress. These mathematical constraints suggest that credit spread normalization requires either massive policy intervention or economic contraction, sufficient to eliminate excess leverage. Given current policy limitations, economic contraction appears more likely than successful crisis management. This means current credit spread levels may represent early stages of sustained economic disruption. Current evidence suggests that credit markets have reached a breaking point. Normal functionality cannot be restored through incremental adjustments or traditional policy interventions. Credit spread acceleration beyond 20-plus basis points in the US and 25-plus in London indicates mathematical relationships supporting credit creation have become dysfunctional. Private credit detonation, shadow banking implosion, and traditional banking paralysis are occurring simultaneously, overwhelming policy response capacity. International transmission is spreading problems globally faster than regional responses. This creates synchronized crisis conditions across major financial centers. Liquidity evaporation and derivative amplification are making credit markets dysfunctional, preventing normal price discovery processes that could restore equilibrium. Corporate refinancing requirements, unmet at current credit costs, create immediate economic disruption. This telescopes crisis effects into the present. Based on mathematical analysis, the credit crisis has progressed beyond normal resolution mechanisms. Stability cannot be restored without extensive economic disruption. Credit spreads indicate the credit creation process is breaking down in real time. This breakdown occurs simultaneously across multiple sectors and regions, overwhelming policy response. Mathematical constraints suggest crisis resolution requires either unprecedented policy intervention or economic contraction to eliminate unsustainable leverage relationships. Policy intervention limitations and the scale of required response suggest that economic contraction is more likely than successful crisis management. Current conditions are the beginning, not the peak, of systemic financial and economic disruption. The credit market breakdown is a collision between artificial expansion and mathematical reality. This collision is destroying the foundation of debt-based economic growth that has characterized global development for over 50 years. The numbers are undeniable. The acceleration is overwhelming. The systemic breakdown has begun. Credit spreads don't lie. When they reach current levels and maintain current acceleration rates, they indicate that the financial system is approaching complete breakdown. The lenders aren't just stuck. They're trapped in a mathematical death spiral that they cannot escape through normal business operations or traditional policy support. The credit markets aren't just imploding. They're collapsing in ways that threaten the entire economic system that depends on credit creation for basic functionality. This isn't manageable market stress. This is financial apocalypse beginning in real time. The warning signs have been ignored. The mathematical constraints have been exceeded. The systemic breakdown has commenced. What comes next will make 2008 look like a minor correction. The credit markets are breaking. The banking system is paralyzed. The economic system is shutting down. And the people responsible for managing financial stability have proven completely unprepared. The credit crisis isn't coming. It's here. It's accelerating. And it's about to overwhelm everything that depends on normal credit market functionality. The breakdown is mathematical. The acceleration is exponential. The outcome is inevitable. Welcome to the credit apocalypse. Population: everyone who depends on credit markets for economic survival, which means everyone. The spreads have spoken. The markets have broken. The system is failing. And failure at this scale doesn't get contained. It gets transmitted through every economic relationship until nothing functions normally anymore. The credit implosion has begun. The banking collapse is accelerating. The economic shutdown is approaching. And there's no mathematical way to stop what's already started when the problems exceed the capacity of available solutions. The numbers broke everything. The system cannot be fixed. The collapse cannot be prevented. Mathematics doesn't negotiate. It simply overwhelms. And the overwhelming has begun.